Hey CMA USA aspirants, welcome back to our Marginal Analysis series for CMA Part 2. Today we're going to master a very practical and exam-tested topic, special order decisions. We'll learn what a special order is, when to accept or reject it, how to calculate the minimum selling price, how to handle scenarios with idle capacity and full capacity, plus useful equations and easy memory tips. Grab your notebook and let's dive in. What is a special order? A special order is a one-time customer request for a product, often at a price lower than your regular selling price. It's outside of your normal operations. The key question is, will accepting this order increase our profit without harming existing sales? The answer depends on one thing. Do we have idle capacity, or are we operating at full capacity? Idle capacity means we have unused production resources, so fulfilling the special order won't disrupt regular operations. In this case, we look at only relevant incremental costs, typically just the variable cost per unit. Fixed costs are ignored. They stay the same whether we accept or reject the order. Accept the special order if the special order price is greater than or equal to the variable cost per unit. The minimum selling price formula for idle capacity is minimum selling price equals the variable cost per unit plus any additional cost per unit such as packaging, shipping, or customization. Alright, here's a handy tip to remember. If the price covers variable costs, it contributes to fixed costs and profit, so it's a yes. Let's look at an example. Suppose the variable cost per unit is $12, and there are no additional costs. If the special order price is $15, then the minimum selling price is $12. Since 15 is greater than 12, you should accept the order. Now let's consider a different scenario. Imagine we're running at full production with no idle time. Fulfilling a special order in this case means sacrificing regular sales. So we must consider the opportunity cost, which is the contribution margin lost on units we can't sell in the regular market. Here's the decision rule when operating at full capacity. Accept the order if the special order revenue is greater than or equal to the variable cost plus the opportunity cost. Alright, let's dive into the minimum selling price formula when operating at full capacity. Minimum selling price equals the variable cost per unit plus the opportunity cost per unit. Now, the opportunity cost per unit is essentially the contribution margin lost on a regular sale, which is the selling price minus the variable cost. Let's take a look at another example to make things clearer. So, imagine the regular selling price is $20 and the variable cost is $14. The contribution margin lost, or CM lost, would be $20 minus $14, which gives us $6. Therefore, the minimum price would be $14 plus $6, totaling $20. Now, if the special order price is $17, we should reject it because the price doesn't cover the contribution margin lost. Another smart approach is to check the total incremental profit from the order. This method helps to ensure that we are making the best decision for overall profitability. Profit from a special order is calculated as total revenue minus total relevant costs. If the profit is greater than zero, accept the order. If the profit is less than or equal to zero, reject the order. Let's look at an example. Suppose we have an order for 5,000 units at a special price of $10 per unit. The variable cost per unit is $7, and there is an extra packaging cost of 50 cents per unit. The revenue from this order would be 5,000 units multiplied by $10, which equals $50,000. The total cost would be 5,000 units multiplied by the sum of $7.50, which equals $37,500. Therefore, the profit would be $50,000 minus $37,500, which equals $12,500. Since the profit is positive, we should accept the order. Let's do a quick recap using a chart. In scenarios with idle capacity, the relevant costs are the variable cost plus any extra cost. The minimum selling price should be the variable cost plus the extra cost, and you should accept the order if the special price is greater than or equal to the variable cost. In scenarios with full capacity, the relevant costs are the variable cost plus the opportunity cost. The minimum selling price in this case would be the variable cost plus the difference between the regular price and the variable cost. You should accept the order if the special price is greater than or equal to the variable cost, plus the contribution margin lost due to the opportunity cost. Alright, here's a handy memory tip for you. Use the M.A.P formula. That's M for measure capacity, A for analyze relevant costs, and P for price versus profitability. If a special order helps profit and doesn't hurt regular business, it's a go. Now let's talk about what not to include in your decision-making. First, sunk costs. These are past expenses already incurred and are not relevant. Second, allocated fixed costs. If they don't change, just ignore them. Only use incremental costs and revenues for your decision-making. You've just unlocked a critical decision-making concept that companies use every day. So, remember, use the right formula based on capacity, focus only on relevant and incremental factors, don't fall for the trap of including sunk or fixed costs, and always calculate either the minimum selling price or incremental profit. If this session boosted your CMA prep, hit the like button, subscribe, and share this with your fellow candidates. More decision-making tools like make or buy and pricing strategies are coming up. Stay tuned and keep learning smart.